Market volatility has returned, and our featured guest today says it's more than just geopolitics at play. Joining us now with more on how investors can navigate these choppy waters is David Sekera, Chief U.S. Market Strategist with Morningstar Research. David, always great to see you. Welcome back to the show.
Hey, good afternoon, Greg. Good to see you.
It feels a lot deeper into 2026 than just mid-January with everything that's going on, this volatility we've seen in the markets. You have a list of all the potential causes of this volatility. As we said, you're saying it's not just geopolitics. Take us through some of the big ones.
Well, all I can say from my perspective is never a dull day when you've got President Trump in the White House. But yeah, we've got all the headlines right now regarding President Trump's new tariff threats, his desire to acquire Greenland. But in my mind, I still think in the short term, yeah, there's some disruptions here, but I think it's still more noise than signal. Now, as you mentioned in our 2026 outlook, we did note that we thought that this year will probably be a more volatile year than 2025. And I did outline, a number of the key risks this year. And of course, one of those is going to be the tariff renegotiations that should be coming up later this year. But in my mind, I think the most meaningful of those negotiations won't be until this summer. We probably have a reevaluation of the USMCA. Maybe that starts in late spring. And then we'll have to restart negotiations with China. That probably comes, this summer. Now, one of the other key risks I outlined in the 2026 outlook was to keep an eye on Japanese government bonds and Japanese yen. Now, both of these have been on a long-term weakening trend, but the risk here was if that weakening started to accelerate and if it accelerated too fast. So I think that was a big driver in the market kind of underneath the surface yesterday. We saw Japanese government bonds yields, rise very quickly. Of course, that then pushes down their prices. If you look at their 10-year, it hit 2.35%. I mean, that was only 1% yield a year ago. The duration of those bonds is over 9. So essentially for every 100 basis point decline or 100 basis point change in yield, you'll see a 9% change in the price. And then the 40-year JGBs got really hit hard. They were 23 basis points wider yesterday. That took them up to 4.25% yield. That's 175 basis points higher than where they were a year ago. Duration on those bonds is 22. So for every 100 basis point change that you have in the yield there, that's a 22% change, in the price. So that just means, in one day yesterday, that was an implied, 5% loss. So to put all of this in context, I would just note that the total amount of JGBs outstanding when converted into US dollars is about 8.4 trillion. So a lot of bonds out there that you're seeing, those prices getting, whipsawed around. Now, we are getting some relief today. We've captured about half of those losses from yesterday. The question is this real investor buying, or is this just the BOJ, intervening, in the market? So for investors, I think really there's two main systemic risks here. So first, could we see an unwind of the carry trade? Essentially those investors that have borrowed in yen and then reinvested in, other dollar or other foreign denominated assets. So if it's no longer cheaper to borrow in yen, you could see an unwind there, which means you would be selling those foreign denominated assets in order to repay that Japanese yen denominated debt. And the other one, which is even more concerning to me, is if you have too many losses embedded on the balance sheets of the Japanese banks and the Japanese insurance companies, that could cause investors to start being concerned about their solvency. Essentially, that's the same thing that happened in March 2023 when U.S. interest rates were rising, which caused big holes in the balance sheet on Silicon Valley Bank and forced that bank into bankruptcy. And of course, as those Japanese yields rising, we also see a lot of other sovereign debt rising yields, as well. So all of that, I think, was a big portion of what caused the market to sell off yesterday and some of the calm we're now seeing today.
Do you feel that perhaps investors are not looking past it, they're starting not even looking at it? Because it gets complicated. Like, you have to understand the carry trade, you have to understand the bond market, Greenland. Some of the more alarming headlines just seemed easier to digest. Is it an investor's peril not to really think about what's happening in Japan?
I think so. Now, I've been in the business since 1991, and even when I started in the business, people always said, trying to be short Japan, was always kind of what they called the widowmaker trade. But it's always something I've kind of had in the back of my mind, personally. And with Japanese yields rising as much as they are, those bonds falling as fast as they have, I think that could cause some solvency concerns among some of the Japanese banks. We saw how it played out in 2023, in March, and so I'm just concerned that could be something which which could start causing some of that credit counterparty risk in the global banks, where some of the global banks may not want to lend to the Japanese banks, which, of course, if that starts, to contract credit, that could have, global economic, risks.
Okay, so with those risks as part of the bigger macro picture, we take actually a look at what we're paying for this market. Valuations, how are they looking?
So in the U.S., when I look at a composite of our valuations of the over 700 stocks that we cover that trade on U.S. exchanges and compare that to the capitalization where they're actually trading, I would note the broad market is undervalued by about 4%. It was trading at a 4% discount, at the end of 2025. So to me, that just means investors probably should be pretty much at their market weight for their targeted allocation for U.S. equities. But I'd also note that the concentration of those mega caps is really what's causing the discount in the broad market calculation. So, for example, if I were to pull NVIDIA or our valuation of that stock out of that broad market calculation, the market would only be 2% undervalued. And then from there, if I pulled out Broadcom and Alphabet, then the market's actually trading at fair value. So not necessarily a broad, wide discount, really very focused on just a couple of stocks that we think are undervalued. When we break it down further, I'd note growth stocks are trading at a 10% discount to fair value, but again, going to be very concentrated in just a couple of those mega cap stocks that skew the valuation. Value stocks, much more broadly distributed. We see a 5% discount there, see a lot of good opportunity for investors in that category. Core stocks at fair value, nothing really necessarily standing out there. And then just a couple of highlights from our sectors, technology, that's at an 11% discount, but again, going to be very concentrated in those AI stocks. Communications, a 9% discount, very concentrated in Meta. Meta in and of itself is over 20% of the capitalization of the communications sector. Real estate, the most undervalued sector at a 12% discount. There, I'd still recommend steering clear of urban office space. I still don't like the risk-reward dynamics there. I much prefer more defensive-oriented real estate and REIT plays. And then lastly, energy's at a 10% discount. I think energy's actually pretty attractive here. When we do our calculations, we use the 2-year forward strip in our model, and then our long-term view for oil is $55 a barrel for West Texas Intermediate, $60 for Brent. So pretty close to where they are today. And then lastly, a couple where I would note that maybe investors might want to either steer clear or maybe underweight. Some of the overvalued sectors include consumer defensive. Having said that, Walmart and Costco, the two largest individual stocks, those stocks are trading at 45 and 50 times earnings today. That seems to be pretty full, if not getting to be overvalued. And then financial services, overvalued, but the reason it's overvalued is that everything that can go right for a bank is going right today. We have a steepening yield curve that's increasing net interest income margins. The economy in the U.S. is definitely strong enough to keep bankruptcies and defaults below historical averages. With markets at all-time highs, they're generating very high fees on assets under management. Their trading desks, their investment banking groups are doing very well. Mergers and acquisitions seems to be heating back up again. But when I look at it, it just seems to me all of that and more is already priced into the U.S. banks.
Okay. Lastly, I'm going to ask you about the small caps. We've been hearing about, despite the fact that the mega stocks always get all the headlines. How's that sector of the economy looking?
Yeah, the mega caps and the large caps, certainly, overshadow the small cap category. Small caps trading at a 15% discount to fair value. So the question is 2026 now finally the year that the small caps are going to outperform? So just before I get to that, I want to give you a little bit of background. So we're actually trading at a pretty similar discount to fair value at the beginning of 2025, but we noted we didn't think that small caps would really outperform until at least the second half of 2025 or late 2025. Now, the reason is that historically, small caps will do best when the Fed is cutting the federal funds rate, long-term interest rates are coming down, and the economy, rate of economic growth has bottomed out and is starting to reaccelerate. And of course, we didn't see the Fed cut until September of last year. The 10-year didn't really start approaching, for that 4% area until fall. And the economy began to strengthen in the second half of the year, really in, third quarter and fourth quarter. So we did see small caps outperform in September, November, and December. I just checked this morning. Year-to-date, Morningstar's small cap index is up 4.8%, much better than the broad market, which is actually down 0.25%. So looking forward, I do think this is one of the few areas that investors are looking at that you can still find a lot of valuation. We're looking for the Fed to ease monetary policy. Our U.S. economics team is looking for 2 Fed rate cuts this year. We're looking for long-term interest rates to decline, looking for the 10-year to break through that 4 handle, looking for it to average 3.9% this year. Economy running much better than expected, really being bolstered by the AI build-out boom. And then I also expect in 2026 a return of mergers and acquisitions, more private equity, more strategic acquisitions. So I think that provides a good tailwind for small caps as well. I just note that small caps probably going to be a little bit risky, a little bit more volatile than you'll see in the broader market. So I do think that for most investors, you're probably better off in exchange traded funds or mutual funds. However, having said that, I do think there are a lot of individual stock opportunities that might be interesting for some of your viewers.